Welcome back. I hope you're having a fantastic day. Last week in the markets has been absolutely mental. We have seen some extreme volatility. Both of my holdings had dropped double digits in different days, and it has been very, very savage overall. The most important thing, as I addressed last week, is to remain calm. However, today we're going to be talking about the recent interventions, a cobweb coming down from there, the recent intervention from the Bank of England, and what has actually really happened here. So for those of you that don't know, the Bank of England intervened earlier this week, and they bought £65 million worth of government bonds, or GILTs, which I think sounds like a horrible name because it sounds like, an anagram for something quite disgusting. So I don't obviously want to dive too far into that, but GILTs effectively are a government bond in the UK, right? This is typically seen as a very safe option. Usually have quite a low yield, but a little bit higher than that of the American government bonds, just because obviously the UK's credit rating is a little bit lower than that of America. So that's kind of what it is. But basically here, the pension funds that were involved had some significant threats, and that's because there was an increased level of sell-off in gilts due to the lack of trust in the government. Obviously, we'd seen their recent fiscal policy release and their mini budget. I don't have much thoughts or comments on that. I do believe, obviously, that they have got to support the economy, and they've certainly got to increase government spending and really help out growth. However, at the same time, there's obviously a balance to be found, and with inflation at a very high level, I feel like the Bank of England's hand was certainly forced, and I think they made a good call here, where they used this 65 billion from their reserves, and it's not quantitative easing because that would be printing new money. They did it from their reserves, which people are complaining about because that's going to go straight back to the taxpayer. Oh well, sod it. All that stuff goes back to the taxpayer anyway. Regardless, what they've done here is they bought the government bonds at 65 billion pounds, and what they've done is they stabilised the markets for a short period of time. And this is because as the bond prices were dropping, this was forcing these pension funds that had engaged in these swaps to sell, because they were effectively in a very leveraged manner, but in a more returns or low risk manner. However, because of this decline, the banks obviously hedged a position. They knew what these pension funds were doing, and so in order to mitigate that risk on their own balance sheet, what they'd done is they'd bet against it. So they'd had shorts in place, but because these shorts were in place, obviously, and this was continuing to fall, this increased the rate of the sell-off. It became a compounding issue, because at this point now you've got these government bonds selling off. Now these pension funds have to liquidate more money to get cash available, and it obviously led to an extreme sell-off. This is where the Bank of England got involved and froze it for a short period of time, and all it's doing at the moment is not stopping the bonds from falling. All it has done is allowed the pension funds here a time or a chance to sell out and really readdress their risk management, which is exactly what it has done. Now, this overall, I think, as I say, is a good policy. They've done this very well, and I think the Bank of England's hands are tied here. They can only execute monetary policy. They've got high inflation. They're already increasing interest rates, and what's happening here is they're putting the accelerator and the brakes on at the same time, which is obviously probably not going to go so well. But at the end of the day, I think you've got to not fixate on what the government are doing, because at the end of the day, the government can either make very intelligent or very stupid decisions, and I think that's always going to happen. The certainty is that we're likely going to be invested for the long term, and that the businesses that you invest in are going to be around in the long term. Do you believe they're going to be long-term growers? And I think that's really where obviously it kicks in. Now, I did ask a community poll here. Do you agree with the Bank of England's most recent intervention in the bond markets? And it seems like a majority here, 53 votes, said yes, 74%. Now, I get into this a little bit more here, and the reason I ask this question is because obviously of the free markets theory. You might be a believer in the idea here that actually it should have been left to crumble down, and that the pension funds should have failed. So let's hear your opinions in the comment section down below. I'm really interested in this manner, and obviously I'm not in any way, shape or form invested in bonds, so therefore my knowledge on this is certainly more limited. Now, obviously I've also been buying some UK stocks this week, but I will jump onto that at the end of the video. I'm also going to talk about Boohoo's interim results. So this is their results for the 6 months ending at the end of August, and I'll be honest with you, I thought this would be far, far worse. Now, the headline figure here you immediately see is that the change over the last year in Boohoo's 6-month revenue is a reduction in 10%. However, this is taking into account a lot of the issues they're having with a high returns rate. So what we're having is these customers, they're ordering 4 to 5 dresses, they're returning 3 of them, and obviously that's impacting their margins. That's why you see gross margins have dropped quite significantly from obviously 2019, where it was about 54.3%, and now we're sitting at about 52.5%. Even a year ago it was at 54.6%, so this has become a very big factor, and it's certainly eating away at their profit line, amongst other things such as logistics and issues in that regard. However, what they have said here is that the gross revenue before returns was actually up 4%. And this business, Boohoo, is a volumes-based business. They're not just going to increase the price of their goods in order to increase sales. What they're doing is they're trying to sell as much products as possible and resist the inflationary pressures. By doing this, they're going to keep their prices as low as sustainably possible, look for cost efficiencies elsewhere in the business, and that's how they're able to maintain a very strong market dominance. What we're seeing here is if their gross revenue is up before returns of 4%, this means their volumes are increasing. I'd love to know on average how much they have increased prices across the board, or if they haven't. That'd be a very interesting metric to see, because then we can see, okay, how much have they risen prices, but how much have they actually seen an organic growth in volume? And that's really key here. And at the same time, obviously, a lot of their wholesale markets in the rest of the world now are doing a lot better, and they're actually returning to a positive level of growth. So this is looking promising indeed. I was expecting their balance sheet to look a lot worse. You can see here at the end of the period, they had a net debt position of £10.4 million. Now, if you remember back to the last update, I think they had a positive net cash position of about £1 million. What they've done here is quite interesting. I thought, well, I didn't expect them to do this either, and that's revolving around their credit facility. Now, in their credit facility, what they've done here, let's see if I can find this immediately. Yes, okay. So what they've done here is they've taken out £225 million from this credit facility. So it's now sitting as debt on their balance sheet, but I think they financed it on a relatively low level. This is because, excuse me here, this is because on the actual balance sheet here, their finance or projected guidance for their finance is still quite low. So they must have quite a low interest rate. So what they've done now, they've certainly increased the level of cash on their balance sheet by a substantial amount. They've got something like £300 million in cash available. Obviously, that's also their debt, but it means that they are very, very liquid and able to adapt easily. They're not going bust anytime soon. And I think based on their assets of the balance sheet, there was a point during the week where they had a lower market capitalization than the assets on the balance sheet, which I find quite ridiculous, and I obviously have topped up. There's a few more things I want to talk about here. We can see their key performance indicators, or KPIs. We've actually seen here that their average order value has increased 26% in the last year. Now, this might be because people are trying to exploit the return system a bit more. I'm not sure. Maybe people are looking for a bit more value for money, so they're stacking up the average order value and buying more at Boohoo. However, the order frequency has still slightly increased, but the overall number of orders has declined by about 10%. So we're seeing a reduction in the number of orders, but actually a greater a value per order. So overall, actually, they're doing very promising. Although we can also see that the number of items per basket has declined by 5% here, which might suggest that some of their goods have increased in price, or that customers are looking to buy the fresh-in clothing, which is obviously going to have a more premium price, and that's why things are doing in that direction. Now, in terms of my portfolio, it's taken a battering in the last week. I'm down 5.44%. I made another top-up. I deposited £1,000 into the market. Now, this is something I'm going to be regularly doing now. I'm going to be upping that top. And what I did here is I bought Games Workshop at a terrible price. I bought them at about £64 a share, and I bought 6 shares of them, right? And I didn't expect them to drop, obviously, further on to now £55 per share. But I don't know that. But it doesn't matter, because in a month's time I'll get paid and I'll deposit more money into the markets. I do think here, in terms of Games Workshop, I do need to be able to do a little bit more valuation on the company, understand what I think their actual fundamental value is. Like with Boohoo, I have more of a clear figure nowadays, and so I can obviously buy a little bit more strategically, rather than just, chucking cash into the markets a bit recklessly here. Now, you can see I've also bought quite a significant sum of Boohoo Group shares. I've got another about 1,800 shares that I've bought in the last week, and you can see that my average here is at now £1.25 a share, which is down from £1.33. So consistent weeks like this, if the price stays low, I'm going to be really throwing that average down. And a lot of you seem to forget that December 2021, my average price per share of Boohoo was £2.17. That is a significant reduction considering the size of my position, the level of my income, and the sheer size of my net worth that this portfolio takes up. So you can see that some progress is being made here. And if you don't believe that was the case, and you don't believe that was my average, just tune back some of the videos or go to my Twitter, because I'm pretty sure I've got it pinned in the tweet of what's happened there. So overall, morale's quite high. A lot of you can't understand here. You're like, well, how are you in such a positive mood? The markets are down. Well, there's more to life, obviously. I found other things that I enjoy. I've got a lot of hobbies and I'm keeping engaged. I'm not focusing too hard on the markets, but I am certainly keeping up to date with all of the financial statements and just making sure that obviously the companies that I own aren't that bad. That said, I was looking at owning a new stock, and I mentioned that a week or two ago, and I was interested in buying the London Stock Exchange Group. However, for now, what I'm doing is I'm just going to be putting the money into 2 stocks that I like, I think are good quality, and you can see that I've been doing a bit of a balance of both. The reason I'm putting a balance of both in is so that I avoid the mistake I made before, where I was just chucking significant sums of money into one stock each month, where I'd done this before with Argo Blockchain because it was falling significantly. That money obviously didn't do too well. So what I'm trying to do here is prevent myself from being a significant idiot by only holding 2 holdings, I know. But with these 2 holdings, if I put a portion of money into both of them every single month, at least then hopefully it's not going to be too impacted in terms of volatility by one stock dropping. However, the one stock that I thought was a bit less volatile was Games Workshop, which has certainly proved this week that is not the case. Although neither of these stocks have got a low beta at ever. And I think once the markets return to a bit more positivity, there is a better outlook, and perhaps the stock market is starting to rise, then I'm going to look at entering some of these positions where I no longer see the value in Boohoo and Games Workshop, and I think I'm going to open about 2 or 3 more positions and then hold a core concept of 5 stocks. I've also got my pension. I'm going to be updating you on that on next week, and I think that'll be quite interesting for you. But have a fantastic day.